Yeah, markets have dramatically shifted expectations around the RBA interest rate hike. Before Monday, there was a 1 in 4 expectation of a rate hike. Now markets are betting that there's a 12% chance of a rate cut today. By the sounds of it, doesn't look like that's going to happen. But by Christmas, 4.1% the markets think will be the cash rate, 40% chance of half a percentage point cut to 3.85%. Do you think that we could be seeing such a big interest rate cut by the end of the year?
Look, it doesn't seem likely at the moment. If the source of this concern in global financial markets is a US recession, the first thing I'd note is that's yet to play out. There's certainly softness in the US data in recent weeks, but whether or not that turns into something more severe or is just a slowdown or a soft landing remains to be seen. So that isn't, I think, enough to generate a big sort of shift here in our economy, which is still generating a lot of employment. We still have inflation above target. So I'm not sure that that's the right way to think about it right now. But of course, things can move very quickly. I mean, if we do see some sort of financial problem emerge out of this, and that sort of means the economy is in worse shape, then things could start to head down that track. So it's too early to tell, but I think that's a little bit ambitious to be looking for a rate cut here before Christmas.
And the US Federal Reserve, they're due to meet again in September with another interest rate decision. Do you think that they could hold an emergency meeting and adjust the rates before then?
Oh, they certainly could if the situation deteriorates and it looks like that threatens the stability of the US, financial system and then economy. But as I said, at the moment, what we're seeing in the United States, I think, is a slowdown in the economy and then a reversal of investment positions out of very expensive tech and in particular AI-related stocks. And then we initially saw that into the broader market, but as the economic data weakened, there was a broader move out of equity. So at the moment, it just seems like a de-risking, a taking money off the table move, happening very quickly, of course. But of course, if this does go from bad to worse and there's elements of some sort of crisis or threat to the US financial system, the Federal Reserve can meet at any time and act accordingly.
You know, central banks, whenever there's been a crisis, they've just started up the money printer and quantitative ease themselves out of problems, but they might not want to do this time around because of inflation fears. And if they don't, and we do have overly inflated asset prices because of quantitative easing, you know, do you expect that this fall could be much bigger than expected?
Yeah, I think what you've just said is an important frame for thinking about this. And of course, this may be coming, this sort of downturn in markets may be coming at a time when we got inflation too high as it is, which would preclude the use of aggressive monetary stimulus. But this all remains to be seen. But I think the point you make is right. We're in a bit of a pickle here because we can't just keep throwing money at these problems as we've seen in the past. But I suggest that might well happen if things get bad enough.